I will talk to you about the most fundamental financial statements that everyone must know, whether you are an investor or a corporate executive or an independent director or anyone else. You must know about three things: balance sheet, income statement, and statement of cash flows. You can say uh, financial literacy is necessary today for everybody, and financial literacy must include these three most important statements, which you should know how to interpret them, how to understand them. If you happen to be an investor of a company, you may go through the annual report of that company, find out these three statements, and analyze them. So, we will look at these three fundamental instruments to strengthen our fundamental understanding and our financial literacy. Every company is supposed to prepare these three statements. So, we will first look at balance sheet. A balance sheet is a statement of current status of a company. What are its assets? What are its liability? If you look at the balance sheet, you can identify its current health in terms of how much money is due, how much liabilities are pending, what are its assets, and what is the state of assets of this company. Therefore, balance sheet is the most important document. It shows the exact financial health of a company on a particular day. Generally, balance sheet is prepared annually, and therefore, in India, 31st March is the last working day as per financial year. So, balance sheet is prepared on 31st March. So when you look at a balance sheet, it is prepared as of 31st March. It shows the balance of that company on that particular day, right? What is the content of the balance sheet? Let us look at it. Balance sheet has two things: assets and liability. Assets are equal to liabilities plus stakeholders' equity. Assets are always equal to liabilities plus stakeholders' equity. That means the balance sheet in balance is always balanced. Balance means two sides are equal. So these two sides are always equal. Assets are always equal to liabilities plus equity. Let us look at example. This is what it is. The assets are shown here. You can see the assets here. I have shown here left side. You can show them right side also. In Indian context, most of the companies show assets in right side and liabilities on left side. But here I have shown assets on the left side. Assets are also classified in two types: current assets and fixed assets. Current assets are those which will change in the next 1 year. Fixed assets are not going to change in the next 1 year or 2 year, because let's say building, let's say plant, machinery, equipment, they will remain at least 1 year or beyond. So they are fixed assets. Current assets will change, like cash in hand. It will change. After 1 year, it will be something different. Inventory, it will change. After 1 year, it will be something different. So they are going to rotate within next 1 year. So current assets include cash, account receivables, inventories. Inventory means raw material, finished goods, other stock that is there in your stock. Account receivables includes uh, if you have sold on credit, then you have to receive their payment. They are your assets and they are called as account receivables. Cash and bank balances, they are also current assets. Fixed assets include your property, land, building, plant, machinery, equipment, intangible assets, etc. Coming to liability side, liability is also of two type: long-term liability, fixed, or and short-term liability. Short-term liability is like you have to pay something. If you have purchased raw material on credit, you have to make their payment. That is called account payable. So these accounts payable are your current liabilities plus your notes payable, your accrued expenses, your outstanding expenses. For example, you have to pay the salaries, you have to pay dues of your employees. They are all current liabilities. And then you have long term liabilities, which include uh, your equity. It's a Equity is a permanent liability, right? Because you are not going to pay them immediately. You will pay when the business collapses completely. Then also you may pay or you may not pay. So, but then there are debentures, there are bonds, there are long-term loans which you have taken. So they are all part of your long-term liabilities. Asset is always equal to liability plus equity. Always. What is income statement? Sometimes it is called profit and loss statement. Sometimes it is called income statement. It shows the total revenues and total expenditure happening in one financial year. So while balance sheet is showing the balance of one day as on one day, the income statement is showing the annual income and expenditure of a company. So it is showing complete income and expenditure of 1 year, right? So this is what you have to understand. Profit is when your income is more or expenditure is more. Yes, you are right. Profit is when your income is more than expenditure. Your revenues are more than your total expenditure. So you prepare these income statement showing income in one side, expenditure in one side like this. Or this is here, I am showing here the total revenues, and at the bottom of revenue there will be expenditure. So now we come to cash flow statement. When you show the flow of funds, where the money is coming, where the money is going, that is called cash flow statement. There are two things: sources of funds, uses of funds. Source of fund is, for example, if you sell an asset, then it is cash in. That means source of funds. If you take loan, then cash is coming in, so it's a source of funds. Similarly, if you buy assets, then it is use of funds. Similarly, if uh, you pay out your liabilities, then it is use of funds. So these are the sources and uses of the funds, how the money is going, how the money is coming, and we must know how to analyze it. By reading cash flow statement, we can see where the money is going or where from the money is coming. It will help us in studying the overall financial health. You can identify. It is possible that the company may be profitable, but it may be devoid of any finance, any cash because of misuse. How misuse? Because it might have overspent the money, it might have spent the money in unplanned way. So cash flow statement is not well managed. Cash flow is not well managed means company is not able to run and company will become bankrupt. So being a good analyst, you should be able to look at the flow of capital, flow of cash, and how it affects the business enterprise. So cash flow statement uh, gives you the basic idea about how the money is coming in, how the cash is coming up, how cash is being recorded. It will help you in analyzing the health of the company. When you look into the cash flow, the first step is to determine the change in cash is to figure out cash flow from operating activity. This is the cash flow that results from normal activities like producing and selling goods. Two type of things are there. One is operating activity, one is non-operating. Operating activities are like running your daily sales and your production activity, and the non-operating activity are like investing in plant, big machine. And then second step is to make adjustment for cash flow from investing activity. Investing activity would mean like investing into uh, some fixed assets. Final step is to make adjustment of cash flow from financing activities. Financing activities are like borrowing money from banks, financial institutions, creditors, etc. So making adjustment of them will help you in understanding where the money is coming, where coming. Broadly speaking, cash flow statement has to show cash flow from three activities: operating, investing, and financing activity. So you can classify them. Operating activities are like producing goods, buying raw material, selling goods. Investing activity are like investing into fixed assets, and cash flow from financing activity include borrowing money from banks, financial institutions, creditors, and paying them off. This is a statement of cash flow, and it shows income of cash flow from operations, which shows your income, your account payable, etc. Then cash flow from the net cash flow from operations. This is the net cash flow from operations. Then investing activity, which means acquisition of fixed assets, sales of fixed assets. And then financing activity means like payment of debt, proceedings from long-term debt, dividend, repurchase of stock, process proceeds from new stock issues, etc. So this is how you can make some uh, practice at your home. Try to analyze a few cash flow statements, balance sheets, income statement, and make prediction. Now, my question to you: what three things should be kept in mind when looking at a balance sheet? Yes, any answer from your side? Answers are accounting liquidity, debt versus equity, value versus cost. Uh, to clarify these points, like a company should have adequate liquidity, means you can compare current asset and current liability. If current assets are more than current liability, that's good. If current assets are less than current liability, it means liquidity problem is there, and then company will face problem. So this is how you can do it. So you have to you have to ensure that the current assets are at least double the size of current liability. Debt versus equity means your debt may be slightly more than equity, but not too much. If debt is 5 times equity, then that's dangerous. So if debt is equal to equity, up to that there is no problem. But if debt is too much beyond equity, it will be problematic. Value versus cost. You have to look at the various aspects regarding value addition in the enterprise and the cost and how the pricing is done for the products and how the company is able to grow. Next question. What are the three things to keep in mind when looking at income statement, or you can also call it profit and loss statement? So income statement has is based on your annual flow of income and expenditure. Give your answer. Yes, there are. Next question is, what are the observations from cash flow? So there are various types of cash flows. You have to look into. You have to look into net income. You have to look into whether where from money is coming, where the money is going out. You have to analyze them.